All right, there is a lot that's been happening in the Bitcoin market, and today we're going to break it all down. What on earth has been happening? Where might we go from here? Are we at the bottom? Is Bitcoin dead? Has anything fundamentally changed? All that and more in today's video. Let's jump in. Welcome back to another video. My name is Ian Major. I'm an entrepreneur, Bitcoin pleb, and all-around raging capitalist, and it was time to do this video. We've obviously seen a lot of crazy price action recently with Bitcoin and the broader crypto market. Those of you who have been following this channel for some time know that I don't typically focus or fixate on the fiat exchange rate, i.e. the price. One Bitcoin is one Bitcoin. That is the most important truism to understand, but I do think it is important because understanding what's happening and the machinations of the market help build your long-term conviction because you know what's happening and you say, oh, it's another one of those. But at the same time, these are pretty unprecedented times, as we will discuss today. And so how on earth did we get here? Where might we go from here? And has anything changed? The answers may surprise you. You won't want to miss a thing. For those returning to the channel, welcome back, my friends. As always, it is a pleasure to have you. And for those new to the channel, I welcome you as well. If you like this type of content, I invite you to subscribe and come along for the journey in our merry growing gang in cyberspace. Cover all manner of Bitcoin related content, including a whole slew of tutorials and how-tos on acquiring Bitcoin, securing Bitcoin, privacy best practices, running your own node, and sometimes analysis pieces like today's video. But with all that out of the way, let's go ahead and jump into the meat for today, starting first with how on earth did we get here and what is happening right now. All right, so it has been quite a few months. Bitcoin is now officially down 70 or so-ish percent relative to its all-time high in November. And it's been in many ways a sort of perfect storm of headwinds. Obviously, even since the beginning of the year, with inflation creeping up, we've had the Fed continuing to posture about raising rates and tightening monetary conditions, which of course, unfortunately so, dictates essentially what happens with all asset prices on Earth. And so you kind of already had a little bit of these headwinds. Bitcoin and the broader crypto market trading like risk assets, similar to the NASDAQ, high correlation as we've seen over these last few months. And eventually that ultimately pushed the first domino to fall, and that domino was Luna. I did a whole video recently on how this sort of came to be, and so I'd encourage you to check that out if you are so curious. But you essentially had the blow up of a $40 billion plus asset. I mean, this is a massive meltdown. Equally depressing that you now have Luna 2.0 and people, aping into that. I haven't been following it, but some people just simply never learn, and you cannot save those people. But then there was this open question of like, what is going to be the knock-on effect? What are going to be the reverberations we may see as a result of this? Is this going to lead to contagion? And unfortunately, the answer has been an emphatic yes. The next domino to fall as Luna imploded has been Celsius. Now, to be clear, Celsius has announced just a couple days ago that they've paused all withdrawals. Celsius was known to have a very large position in the Anchor protocol and Luna as well. And one thing that is for sure is, it turns out Celsius has been doing a lot of really risky things with its depositors' funds, pumping deposits into all sorts of DeFi protocols and yield farming and all this stuff, right? So it's one giant ball of leverage and risk. And you had a lot of rumors, starting to swirl around, and that was just a snowball that gained more and more momentum. More and more Celsius users started pulling their funds out of Celsius. So this is essentially a bank run. And ultimately, Celsius had to stop withdrawals. The question is it a liquidity crisis, meaning they just need to get their assets back, even though they're constantly being marked down as prices decline everywhere? Or is this a solvency crisis, which would be a lot worse? I mean, you could have, full-on bankruptcy proceedings and all this good stuff. To be clear, I am not sure where this is all going to land. Some of the latest analysis I've seen is that Celsius does appear to be inching in the right direction in terms of paying down and unwinding some of these bigger trades, but there is still a long way to go. And so if you are impacted, I've seen this post from a guy, Joshua Browder. I'm going to post this in the description down below. He goes through a kind of step-by-step guide of seemingly a cheeky way to get some money back and go ahead and do this. Now, I'm not, none of this is financial advice. I'm not necessarily going and recommending this, but I came across it. And so for those of you who may be impacted, if this is helpful, I figured I would share it. I think best case at this point, if Celsius does re-enable withdrawals, they're probably going to put a pretty severe cap on that. So, you're going to be able to just dribble out a little bit at a time because they know everyone's going to take all their money out, right? And so again, I'm not going to hypothesize further than that on where this all lands. But then the next domino, right? This domino effect, it's brutal. This is what happens in a deleveraging. 3AC, so Three Arrows Capital. This is one of the largest crypto kind of venture capital funds. As Zhu Su has just noted here a couple days ago, we're in the process of communicating with relevant parties and fully committed to working this out. They have been margin called, so they are in the process of, probably coming up with more capital that they can put down as collateral. And not surprisingly, 3AC has massive stakes in a lot of different assets, a lot of different protocols. So suffice it to say, how many times have you heard me say this on this channel? Get your Bitcoin off exchanges, get your Bitcoin off third parties, especially borrowing and lending platforms. We saw BlockFi announce that they're laying off 20% of their staff. Nexo has appeared to make an offer for the Celsius loan book, which is quite interesting. But again, trust no one, especially in these trying times. Take self-custody of your Bitcoin. And while my heart does go out to those of you who may be impacted by all of this, at least learn from this. At least take this lesson forward. Not your keys, not your coins, right? This is why people say that. And so if that crypto contagion wasn't bad enough, we've continued to see a worsening macro backdrop. You had inflation accelerate from 8.4% in April to 8.6% in April. Of course, this is US inflation. Again, given that the US inflation will inform what the Fed does and that the dollar is the reserve currency of the world and treasuries are the reserve asset of the world, this impacts everyone and everything on Earth. And so this was pretty wild. A lot of people were expecting that inflation would finally turn over or at least stop accelerating. But the fact that it went from 8.4 to 8.6 from April to May was just pretty astonishing. And as we all know, CPI calculations are complete crap. So the real number is way, way, way higher than that. And so, not surprisingly, there was more and more loud yelling for the Fed to really take emphatic action, and emphatic they did. They raised the federal funds rate by 75 basis points, 0.75%, the largest, as you can see, since 1994. Powell is talking about another 50 to 75 basis points in July, which we can probably assume is baked into asset prices currently. But I think one big risk is if inflation continues to accelerate from May to June, that would really, really light people's hair on fire, given that the Fed just came out with this 75 basis points rate hike. And as part of that, not surprisingly, you have all assets down. Basically, the dollar is doing well against everything else other than the Russian ruble. That's a story for another day. But as you can see, these are the handful of years in which the S&P 500 returned negatively. And what's wild is, as you can see, all those years that the S&P returned negatively, bonds at least returned positively. But you can see that year to date, 2022, this is a great view from Charlie Bolello, both are down. And this is highly reflective of the sovereign debt crisis that folks like Luke Grauman have constantly been talking about. When stocks are down and bond prices are down, you are in deep, deep trouble. The classic 60-40 stock bond portfolio has been absolutely battered. So think of the implications for 401ks for folks who are getting ready to retire and had counted on X, now they're getting Y, right? So this will start to have a very serious effect on consumer spending, etc. And so the Fed is in a really, really hard position. They've basically had to choose between trying to quell inflation and avoiding what, would potentially be a disastrous recession. We are already starting to see lots and lots and lots of signs of things starting to break Credit spreads are often a great signal for that. As we can see here in the high yield credit default swap, we're basically shooting up, towards where things went during the March 2020 craziness with the pandemic at the time. I mean, the yen is blowing up, JGB yields going through the roof. The euro is looking horrible. I mean, awful, right? Like, one really has to question when, not if, the euro will come to an end. The ECB, as you can see, basically came out on Wednesday saying it plans to create a tool to tackle the risk of, quote, Eurozone fragmentation, i.e. you have borrowing costs that are soaring for certain highly indebted parts of Europe like Italy. And so that is going to put a ton of pressure on the euro, especially as the Fed does what the Fed is doing. So in a nutshell, with monetary conditions tightening, liquidity is getting tight, rates are increasing, so by definition, asset prices are falling, and basically everyone is just scrambling to get liquidity. Sell your assets. Even if you like the assets, sell whatever you can to get liquidity to make sure you don't go insolvent and that you can pay your debt. That is what every actor on the planet is basically thinking and doing currently. So that sounds pretty bad. But let's talk a little bit more now about where we might go, what impacts this may have for Bitcoin in the near and farther future. All right, so when do we get to the good news of this video? Well, not so fast. People are talking about when the recession will start. I and others think we're probably right in it, right? The recession has already started. We're coming to a screeching halt in terms of economic growth. You can see how GDP estimates for Q2 in the US have been continually revised downward. It is now sitting at a whopping 0%. But you're seeing the US personal savings rate plunge down basically to, kind of where it was quite some time ago after you had all the stimulus checks as part of the pandemic. As Charlie outlines, you also have the highest year-on-year increase in consumer credit since 2011. So basically, people are going through their savings really fast given the increase in prices. They're starting to take on more debt in order to make ends meet. We've seen companies start to announce layoffs. You had Walmart and Target starting to flag concerns. This was even a few months ago. Then you had the likes of Coinbase, BlockFi laying off quite a few folks in their workforce. And it's not just crypto companies. There are, other companies in the broader economy as well that are announcing layoffs. So unfortunately, stagflation seems pretty clear, kind of high inflation. Even if inflation rolls over, it could still remain quite elevated for some time to come. And we're clearly heading into a low growth. And if we're not in a recession currently, we certainly will be in a little bit. So what does this mean for Bitcoin? Are we at a bottom? 20 to 22K looks reasonably comfy for a variety of reasons. As we can see here, price has finally pierced realized price, which is kind of the aggregate cost basis of, coins the last time they moved. And so as you can see, when you pierce this, you're usually not below that for too long. And we can see that even more clearly in this Z-score of kind of the ratio between the market price and the realized price. We've kind of finally entered this accumulation zone for the first time since March 2020. So that's pretty significant. You have the Meyer multiple. This is a very popular ratio for measuring price in relation to recent historical performance. So this specifically looks at the price divided by the 200-day moving average, and we're currently sitting at 0.53. And so basically this is one of the lowest readings of this multiple ever, right? Number 5 on the list here from Dr. Jeff. And it appears that finally we're seeing miners capitulate, which is actually a good sign, right? It typically indicates that you're either at or very close to the bottom. The red here indicates a position change, a negative position change for miners, which really means one of two things. Either they're taking profits, so you can see some instances where there's a lot of red when the price is just ripping upwards. That's miners taking profits as price increases. And then the opposite of that is when they are capitulating, meaning, look, I'm literally no longer running profitably, so I need to turn things off. This is particularly the case for older models of ASICs that are not running as efficiently. So the takeaway here is that if history is any remote indication, Bitcoin is at really, really, really attractive pricing currently. With that being said, as we discussed earlier, there still is this kind of ongoing contagion and an open question of how much more will be impacted. And of course, you have the big variable of what the Fed will do. It was interesting to see risk assets rally when the Fed increased rates, because they're basically assuming that hopefully that will indeed quell inflation such that the Fed doesn't need to raise rates as much in the future. So there's this kind of cobbled web of logic that is dictating what happens with asset prices currently. A lot of uncertainty still. Gun to my head, if you ask me where the actual bottom will finally rest, my bet is probably between 15 to 20K, but I could also be totally wrong. And so make your own conclusions for what you will. If you're a trader trying to take advantage of short-term price swings, that is certainly not my style, and I know it's not the style of many who watch this channel. And so if you're a hodler, the question we really always need to ask is, has anything changed? Has anything fundamental changed? Well, we just hit an all-time high in hash rate. Do expect that will roll over a little bit as we see some hash come offline due to certain less efficient miners now running kind of right at production cost for Bitcoin. So I do think we'll probably see that come down a little bit. But we can also see in this kind of Bitcoin demand curve from Jurrien Timmer, who is over at Fidelity and has always had a pretty good eye for Bitcoin. And they've certainly embraced it a lot more than many other kind of traditional financial institutions. But he has this view of price of, well, this is actually market cap in black, plotted against non-zero Bitcoin addresses. And as you can see, it is more or less a one-way train up. And there was a great report recently. I could probably do a whole video on this, Blockware Solutions, where they basically looked at different adoption curves for technology over the past. And the sort of punchline is this view here, where they're projecting where we are in relation to the broader adoption curve. And as you can see, and as the meme goes, we are still early, my friends. And this is not just some kind of random Moon Boy report. Like this was peer reviewed by folks like David Puel, Eric Wall. So, I mean, this is a pretty robust methodology. I really like how they put this together. I'll put the link to this broader report in the description down below for you to take a look at if you are curious to read up on some of the methodology. But there you have it. Nothing's changed other than the attractiveness of the fiat price that you can acquire more sats at. With all that, let's go ahead and wrap today's video up. So there you have it, my friends. That was a beast of a video. I know we walked through a lot of different views, but I thought it would be helpful just to try and assemble everything that's happening, at least the most important pieces in terms both of the macro backdrop and this kind of ongoing contagion that I will be closely watching in the world of crypto. While none of this is financial advice, I can tell you what I am personally doing, and it's the same thing that I always do. I dollar cost average into Bitcoin, putting the same amount of fiat dollars in every week. I take absolutely no leverage at any time, and I take self-custody, right? I don't have my coins on exchanges or other third parties. Do that, my friends. I think you're going to be just fine. And be sure, if you haven't already, to check out my other video I did just the other week on different ways that you can make sure you're not leaving sats on the table for everyday transactions that you're doing. I know a lot of people don't have dry powder. They've bought all the dips already. You still can be stacking sats by making everyday transactions. So check that video out where I go through some of my favorite tools to do that. But I'm curious to hear, what are your thoughts? I know this was a little bit doom and gloom, but the good news is that Bitcoin just really doesn't care. TikTok, next block, Bitcoin continues to operate perfectly. The Fed will certainly be forced to pivot. I would defer to someone like Luke Grahman for the timing for that. He estimates Q3, Q4 of this year. But what do you think? Let me know your thoughts in the comments down below. I hope you found this valuable and useful. If you did, you already know what to do. Give this a like, share this content out. That really does help with the algorithm to get this to more folks. Subscribe if you haven't already, because I will definitely be tracking these different pieces as we go forward. But for now, we'll go ahead and leave this here. As I always say, as a reminder, every sat counts. And until next time, I'll see you then.